Welcome to a new wave of entrepreneurship by Venture for Canada. Venture for Canada is a national charity on a mission to foster the entrepreneurial skills and mindsets of young Canadians. Our vision is a Canada where young people can equitably realize their entrepreneurial potential to help build one of the most prosperous entrepreneurial ecosystems in the world.
I am very excited to have Glen Silvestri, managing partner of Sage Capital, on Venture for Canada's podcast, A New Wave of Entrepreneurship. And Sage Capital is one of the principal investors in the search fund entrepreneurship through acquisition space in Canada, a space that Venture for Canada has done a lot of work on kind of in the last 5 or 6 months, and is planning more initiatives related to. And in this interview, we're really excited to dive into what's involved in investing in the world of search funds, which has been around long time in the US, but is still relatively nascent in Canada. Glenn, thank you so much for coming on the show today.
No problem. Glad to be here and hope to promote search funds.
So, to get things started, some of our listeners may not necessarily know that much about search funds. What is a search fund?
It's pretty simple. A search fund is a vehicle that allows an individual to run a company and basically buy it from the current owners. And that owner is usually an entrepreneur or a family that is retiring or wants to step away from the day to day of the business. And so, what we do is we'll back a searcher. So, we might give that person a pool of capital between many investors of around, anywhere from 350 to $500,000. And that pool of capital allows them to go out and find a business that they want to buy and run. So those are the two tenets of search funds. You're going to have to buy a company and you're going to have to run it. And so that searcher, the typical profile is someone who's probably in their early 30s, likely has worked as kind of an engineer, an investment banker, private equity, an accountant for maybe 5 or 6 years. And then, maybe has done an MBA at one of the top schools that actually support search, such as Stanford, Yale, INSEAD, just to name a few. That's a typical profile. I'd say to you, the profiles range. There's people that have done many facets and things in their life to get to that point. But you always kind of keep the two facets of search funds that are the base of it clear, which is one, you're going to buy a company, and two, you're going to run that company. And typically, those companies are somewhere between 1 and 5 million of EBITDA.
I find the history of search funds and how they first kind of got going in the US fascinating. For our listeners, can you give a little bit of context of how the search fund industry first got started?
Yeah, so the search fund industry actually got started in the US. It was actually a professor, and he basically said there's different ways to become entrepreneurs. And he backed an individual who wanted to buy a company. And basically, I would say to you, it's the first real crowdsourcing model that was out there, crowdfunding model, excuse me, where a bunch of people got together and backed someone to buy a company that needed succession, and it turned out to be a really big success for both the searcher and the investors. And so, on the back of that, the professors got together and basically started a model and put some, I would say, some bricks and mortar around it to talk about, hey, how much would the searcher get? How much equity would the investors get? And put parameters around how to do it. And, the search fund model was born. I can tell you since then, that was, I believe that was 1984. Since that time, you've seen the search fund model really explode. There's been over 300 search funds raised in North America, and the returns have been phenomenal. The returns have been well beyond what I'll call regular PE is, but also beyond what VC is. Now, on the flip side, obviously, it's a pretty small amount of capital that's gone in. So call it $1 billion over that time period. So while it's a real small piece of capital for the capital markets, it's returned a pretty impressive rate of return. And you'll see lately that more and more people are, engaging in search fund activity and trying to invest in it because it has had a very long, successful track record.
To give a little bit more context about the returns, according to the Stanford Search Fund study, what are some of the financial returns that investors have reaped in recent years on an aggregate basis through investing in search funds?
Yeah, so I'm going to go with what's in there now versus what I think are more the returns. So the returns have averaged somewhere around 3 times and kind of 30% IRR, which, if you put against a regular PE firm today, and I won't go over time, I think most PE firms today are kind of returning more in the kind of 2 to 2.25 times and, around a 20% IRR. So it's been a pretty good run for the funds. There's been some outstanding returns. Assurian probably being the pinnacle of search funding, where I think the two individuals who did that deal are driving much nicer cars than I am. So it's but search funds certainly over a period of time have reverted to the mean. It's just the mean happens to be higher than what the mean is for private equity. So if you look back kind of 15 years ago, that 3 times might have been, I believe, 3.3 or 3.4 times, and that 30% IRR was kind of more like 35%. But again, if you look at the data overall, the search funds have returned quite a bit more, even on a risk adjusted basis, I think, than PE has.
It's such a an asset class that has performed extremely well over the last couple of decades. One thing to zoom in on a little bit, though, this is a line someone recently told me, is he said, okay, the reason why search funds have performed so well over the last 40 years is because you have these people from really elite institutions, Harvard MBA grads, Stanford grads, and there's a little bit of that. Okay, you're investing. They were like, okay, it makes sense. The asset class has performed really well. You have some of the top minds graduating a business school and from other backgrounds going to go run these businesses. So they argue that there's nothing necessarily intrinsic about the types of businesses that are being bought, that it's really a talent play, and that's investing in extremely high potential kind of talent, and that's what explains the returns. I guess, what are your thoughts on that person's argument?
I don't think it's a bad argument, to be honest with you. I think you are getting very talented people to run corporations that otherwise, I don't want to insult anybody who's an entrepreneur, but wouldn't get that level of talent. So there's certainly an argument to be made that is happening. But if I take that argument a bit further, I mean, we have searchers from all walks of life now. They're not just from Harvard, Stanford, INSEAD. We have individuals who are CPAs in Canada who are very successfully running businesses right now. We've been able to recruit people from Rotman Western who are very successful entrepreneurs. And not that I would say that those schools are, a lesser brand of school, but certainly they don't rank as highly on the world rankings as maybe a Harvard or Stanford would. So I think that thinking has really expanded over time. Certainly at the beginning of search funding, you would definitely see a very big bend towards kind of the Harvard Stanford model. But now you're seeing a widening of the type of people that are coming into it. And I would say at the end of the day, it really comes down to the individual, right? And can that individual actually bring a change to the organization? Can they make it grow? Can they make the people follow them? So I think it goes beyond just being a Stanford, Wharton, Harvard grad. It goes to, is that person, whether they are a graduate from that school or whether they come from somewhere else, are they able to bring change to that organization and make it grow? So the person themselves really drives what's going on.
What are the typical profiles of like the non-MBA searcher? So you mentioned like a typical profile of historically of a searcher is somebody who has graduated from a top business school, has some private equity or consulting or investment banking experience, and then goes to launch a search fund. What are the newer profiles that don't fit in that mold?
Great question. I think what we're seeing in Canada, and more specifically, is we're seeing certainly, I'll say, higher educated people coming into the space. So, you do require a certain level to kind of get access to play and get access into the door. But where we're seeing people come into search funding and actually be successful, and I'll use the example because I'm one, is CPAs. And particularly, and even though I'm not one of these, particularly people who worked at a smaller firm, at CPA firm. And what I've kind of done a little bit of a deep dive on those people. And what do I see? Well, they tend to have done a lot of transactional work at those firms. So they might have done some M&A. They've also done some TS work, so Q of E work. They really understand the inside working of a company going through that. They've also done a lot of tax work and just regular accounting work to understand how companies flow their revenue through and what their expenses should be. And so, I'll contrast that with a bigger firm. If you're at a big firm like KPMG or a PwC, typically if you're working at those firms when you're younger, you don't get that kind of access. You're working on a very small, minute piece of an audit. For example, it might be, hey, I'm focused on the receivables. The guys from the smaller firms and gals tend to have a wider breadth of experience that they can draw on, that really molds well for what they want to do in a search fund. Where do they fall down a little bit versus, I'll say, the more traditional searchers? They probably haven't had as much strategy work, and so we will help them with that. But certainly in taking a deal from kind of soup to nuts, they're pretty good at doing that actually, and they're very good at modeling it and very good at thinking about where the cost base should be, where it is today, and how they can move forward. So that's one example of people that we've backed that have been very successful. But there's also been engineers that went back and did an MBA, not necessarily at one of the bigger schools. And probably our most successful investment is with an engineer who did an MBA, and he bought an industrials company. He loves tinkering with the product, and he was able to tinker with the product to the point where he brought gross margins up kind of 500 basis points by bringing everything in house. And his MBA experience taught him how to run a business. So I would say to you, the ring to get in is pretty much the same. I think you have to have a really good business education. I think you have to have the right personality, but it's no longer really stuck to just people who went to Stanford, Harvard. It's kind of evolved over time, and certainly Canada, I think, has been leading the charge on that.
So if you're listening and you're interested in potentially launching a search fund, you don't need to have an MBA from Harvard to go and launch it. And to Glenn's point, there are really diverse career people with very diverse career backgrounds that are getting into search funds and entrepreneurship through acquisition. Over the last 6 months, I've spoken with around 75 people who've done ETA in Canada and the US, and I've been amazed, especially the more recent ETA entrepreneurs, the diversity of experiences from people who were sales executives who don't even have MBAs, who are involved in launching search funds, to folks that have a lot of just more kind of general management experience as well. But to zoom in a little bit to your background, Glenn, how did you get involved in this space? So you're a founder. You launched Sage Capital Partners. How did you get into investing in search funds?
Yeah, I call my career the roller coaster downhill. I started at Ontario Teachers, and I was doing kind of smaller deals to start with because we were a pretty small organization at that point in private equity. But obviously, we got into very large, multi-billion-dollar transactions. I then went to a smaller private equity shop. I really wanted to do something entrepreneurial with my life, and stayed there for 4 years and learned a lot from the partners there. And in that time, I started investing in search personally. Mario Negro and I became friends, and he's the godfather of search in Canada, certainly from an advisory perspective. And nobody gets anything done in Canada unless Mario's a part of it. And so when he started talking to me about the space, my first reaction was, "That sounds absolutely crazy, and I'll never invest in it." So basically, you're telling me I got to invest in kids that have no experience to run companies, and I put my own money in, and they have very little oversight. And he's like, yes, and it does really well. And I said, crazy. And so I followed him in and invested in a couple of deals, and I got really interested in it. And so I became not only an investor, but I advised on a couple of companies and became a board member personally. And on the back of that, I realized there was a big hole in Canada as far as helping some of these people invest in these businesses. They certainly had the skill set to be able to do a big part of it, but they didn't know the Canadian landscape in terms of being able to go to the right lender, being able to go to the right Q of E provider, being able to take a deal and really negotiate to get yourself in the best light possible to make money for yourself once you actually close. And so I joined two boards, and then on the back of that, I said, you know what, I'm going to launch a fund because two things were evident to me. One, the ability to be the first one on the ground and actually be a pioneer in the market and invest in it. And secondly, I realized very quickly I was going to run out of money if I didn't do that because I had 50 phone calls within a couple of weeks once I invested in two businesses personally. And so that launched Sage Capital back in 2019. And if I fast forward to today, probably happier than I've ever been in my life from a professional perspective. And we have over $100 million under management. And John and I, my partner, enjoy coming to work every day and working on these small companies because we think our skill set, being an accountant with a lot of governance experience, and John being a lawyer with a lot of small market experience, especially in lending, really plays well to what the search fund community needs. And we're able to, help them and hopefully drive results over time.
One of the things that's I found striking about the entrepreneurship through acquisition space in Canada is just how happy a lot of people are who work in this space and that sense of like personal fulfillment. And it's awesome to hear that from you as well, like that joy that you have in building something and in supporting a lot of other people to build something. And kudos to you on making the plunge and providing more access to capital for people to launch search funds.
Yeah,
In terms of you, oh,
we
you go.
call ourselves the Bhutan of investing, right? We are the country of happiness.
That is a good. You should put that as like on your website if you don't already
A
have it
new
there.
moniker. I just made it up. It's perfect.
It is perfect. Yeah, the Bhutan of investing. And as an aside, too, one of the things I've enjoyed about the entrepreneurship through acquisition space is just how helpful people are. Versus, I Venture for Canada, we work in a wide variety of spaces in the economy. And I've loved ETA just because people like yourself are very generous and helpful. And partly the reason I've connected with 75 people is just I talk to somebody, they say, oh, you should talk to this person and talk to this person. And it's one of the reasons why Venture for Canada is launching an entrepreneurship through acquisition training course later this year, which is why this content is very in line too to what Venture for Canada is interested in doing. But one question for you, Glenn, is to kind of focus a little bit more on your firm and your investment approach. What is your investment criteria that you use when you're deciding who to invest in terms of search fund?
Yeah, so I'll separate those by who are the people that we back in search versus what companies we back. So, when we look at a searcher, I think we're probably a little more open to various backgrounds than maybe some people in the market, and that kind of just is what it is, and it goes back to probably what our strategy is from a searcher perspective. We will back searchers by ourselves, so we don't have to have 12 people invested in that searcher. We've actually often gone in and said to people, look, we'll figure out a way that we do this just with you one on one. And so probably a third of our deals end up being control deals or one-on-one deals with a searcher. So that's a little bit different than many other firms. I'm not going to say that that's a unique thing because we did take it from U.S. models where people do search alone. Uh, I tend to think Canada is not a big enough market to just do search alone to deploy the amount of capital that we want to do. But also, I like participating in the greater ecosystem because I think it has benefits. So we run across the spectrum. But kind of back to your question, what I look for in a searcher is obviously table stakes, right? You have to have a pretty good education, you have to have good work experience. But what's more important is to sit down with that person and really understand what motivates them and what they've learned over time and what they've learned from failures. And I always say the number one thing that we look for is when that person buys that company, are they going to have the gravitas and the most overused word leadership, etc., to be able to go in and tell a 55-year-old controller, CFO, head of marketing what to do and to actually motivate that person to follow them and do it, right? Because that requires a different skill set. You're not going to just go in as a 33-year-old and tell someone who's been in a company for 25 years what to do. You really have to get them there, and you really have to lead the horse to water and make sure that they're following along. So that's what I look for in a person. Do they have good listening skills? Can they be coached? Do they actually want to take a business and make it larger? And really, are they able to take their thought process and download that to someone such that they're going to follow along? So those are the skills that we look for on the softer side. And then in terms of, when we look at a company, uh, we're very wide breadth in terms of the companies we look at. We probably won't look at something that has a lot of exposure to a commodity. We probably wouldn't look at a company that has a wide real estate component to it. But typically, we're looking for a company that has good recurring or reoccurring revenue. I think one of the things you see in search funding is people say, "Hey, I want 90% recurring revenue." I'm not sure that, that's been a model that's totally been followed when you look at people's portfolios. But it more is along the lines of, do the customers come back? Are they happy? Is it a model or a company that has a moat, right? Is there something around it that says, yes, they will continue to operate and have the gross margins and net margins that they have, such that, no one can come along and really just take over and bully them out of the way. And then lastly, how big is the market they're playing in, right? TAM is very important, right? If you look at a TAM that might be, 50 or 60 million dollars, well, that's not that exciting. But if you're looking at someone that's playing in $1 billion market and they're $10 million of that market, you can see your way to being $20 million of that market and still being small enough that the next buyer has an opportunity to grow that business and pay you a very fair multiple. Well, that's really interesting, right? So those are kind of the tenants that we look for. And so, again, in terms of companies, I mean, we've invested in everything from education to hard industrials and kind of everything in between. Most of the time, if I had to tell you what we're looking for, it's a services business. So a B2B services business is kind of straight up the fairway for us in terms of what we're looking for.
Thanks for that context. And to zoom into a little bit of your first point, you talked about how you invest in traditional search funds, of which earlier in the interview, I think you gave great context about like what is a traditional search fund. But as mentioned on your website, and as you alluded to, you also invest in what you describe as like non-traditional search funds or other kinds of investment opportunities. Um, can you just go into a little bit more detail for our listeners about like what is a non-traditional search fund and what are the non-search fund type things that you invest in within the lower middle market?
Yeah. So I'll give you an easy example. We had a person that we knew quite well, and it was a bit of a unicorn because it was a female that was looking to be a searcher, but kind of didn't want to go through the whole. I want to raise a search and then I want to go out and find a company because she was working at a family business, and so got to know her pretty well over 6 months. And what was she looking for? Well, she was looking for something that played well to her strengths. She wanted a smaller business in services. She was a professor at Rotman, so she really liked education. She was very in tune with what was going on in the schools, particularly in the private schools, because she was providing them school uniforms. And so she was the CEO of a business called McCarthy. And so kept talking to her. And over a period of time, I thought, okay, I have to go look for an education business where we can partner. And so, serendipity and me being a person who absolutely talks to everyone, no matter who they are, I was playing soccer one day and guy on the other team got to know me. He's an accountant. He said, I'm in the middle of selling this business. It's an education business based in Toronto for very scholastic K to 12 students. You know anyone who might want to buy that? And I looked at him and it was like, wow, everything kind of tick, every box hit. And I said, I'll call you tomorrow. I called Vanessa first and I said, here's an interesting opportunity. She said, I love it. This is exactly what I'm looking for. And kind of all the stars aligned. And she was a female entrepreneur. The seller was a female entrepreneur. And we ended up buying the business as 100% backer of Vanessa. So if you look at Vanessa's background, yes, she's a CPA, yes, she has education, but I'm not supposed to disclose her name, her age, but she would be older than 40 and younger than 45. So she's not in that search fund kind of straight up the fairway age bracket. She's had more experience than most. So she's actually run a business. She was an accountant. She actually worked in M&A as well. So she had a really, really good background for running this kind of business. And here we are, kind of 2 years into that investment, and it's worked out, pretty well for us. And so, that's a little bit of a non-traditional way to find a business. And I always say, like, look, we're in the business of investing to make our investors outsized returns. I'm not going to put myself in a box and just tell them this is the only thing I'm doing. I'm going to try and find unique ways to find opportunities to make the money. And that's a unique way to make money for our investors. And we think in the long run, it's going to work out well.
I noticed some folks will use the term like non-traditional search fund or like non-traditional ETA entrepreneur in the context of being like self-funded, and then obviously there's a lot of different kind of permutations of self-funded. But maybe the first question is, and while it might be somewhat intuitive by the name, for the listeners, can you describe a little bit of like what does a self-funded searcher mean, and what are the different kinds at a high level of self-funded searchers?
Yeah. So, I mean, self-funded typically means they just haven't raised a fund at the front end, so the $300,000 or $500,000 of seed capital with kind of the 10 or 12 investors. So they're funding their own search. So they're not getting a salary. They're probably paying their own expenses, et cetera. So you know, the question is kind of why do they do that? Well, a lot of people will say, hey, that search capital is very dilutive when you take it because you got to pay back the investors 1.5 times. And secondly, like, I don't want to be put in a box as to who my investors are. I want to, I want to be able to choose my investor once I've found that investment. And then the last piece is some people, don't like the search fund economics, and they'll say, hey, I want to tweak the economics. So I go find my own deal. I can actually do that. And so typically the independent searcher or the non-traditional searcher will be someone who probably has enough money, frankly, to live without doing a traditional search, and probably has a really good um, uh, avenue towards doing a specific deal. And so those are the type of people we still talk to literally on a weekly basis. And they can be quite a good avenue for finding different deals for the fund. And I think they're, in terms of the ecosystem, they're a very important piece of it. They actually will provide us, for example, an outlet when we get an entrepreneur who calls us and says, hey, I have this business and I don't know what to do with it, but could you introduce me to someone? And so, I've had that happen many, many a times. And I say, okay, let's go through our searchers and our independent searchers, and let's really find the person that matches that industry and matches that person. So, example, we had a company call us, steel industry, two individuals owned the company. They were, I'll say, more very entrepreneurial guys who didn't have an education, guys who were kind of on the rougher edge. And if I had sent them a 30-year-old searcher to talk to them about their Harvard MBA, that probably wouldn't have played really well in that circumstance. Whereas we sent in a 40-plus-year-old searcher who had worked in a bunch of industries, had some successes, had some failures, but had a gray beard. And we thought that's what's going to play really well with these people. And, we own 100% of that company today because of those selection processes that we made.
That is a great example of the differentiated types of entrepreneurship through acquisition. And by the way, for our listeners, when I use the term entrepreneurship through acquisition, it's essentially anybody who's going out and kind of buying a business and then trying to grow it. And search funds are a kind of entrepreneurship through acquisition. So are self-funded searchers and all of these different points. And I think one thing to underscore what Glenn was saying is that there's also not this dichotomy between traditional search or search fund and self-funded. Like there can be a degree of fusion between the two. Like as Glenn kind of mentioned, self-funded searchers can also raise investment. It just means a lot of times the self-funded searcher can sometimes have majority ownership of the company, but there can be significant other equity players. Would you add anything to that, Glenn?
Yeah, I was just going to say the other thing that comes to mind certainly is there are some searchers who say, "Hey, I'd like to add the value that I think I can bring to these companies at more of an executive chair level, I'll call it." So they say, "Hey, I want to do 2 or 3 deals, but I have a background that lends itself really well to adding value to them from uh, a a bunch of facets." So example, hey, I've done a software deal before. I've run it. I know exactly what it takes to actually take that from A to Z. So now what I want to do is I want to raise some capital to do 3 deals and be really involved in 3 deals. It's almost an independent sponsor model, but it's done through search. So I've seen people do that lately quite a bit. That's not something we invest in because it's not part of our ecosystem, but it's not to put it down. It's just a different way to do things. And it still involves search, and it still involves being an intimate part of that company. It just means you're not running it. And so I think that's another outlet that has, or branch that has come out of search. That's really interesting, I think.
There are so many different kinds of opportunities for people to pursue entrepreneurship through acquisition. And while Search Fund is in many ways the most well known, I think one of the things that someone should consider if they're going to do ETA as a career path is to figure out what is the type of ETA that makes the most sense to them. Zooming in a little bit back to your career in terms of investing in search funds, beyond providing capital, what are some of the other ways that you support a search fund entrepreneur to be successful in their enterprise?
Yeah, I think, look, I like to think that we're adding value from multiple perspectives. So during the diligence process, helping people select the right diligence providers is something we do well because we know which banks like which deals, and we know which providers will be able to give best pricing on, products that we need, such as QV, etc. Secondly, given John and I have both worked in the market a lot, we have a pretty large p- network of people that we know. And so, if you're working in software or you're working in garbage collection, chances are we can find someone in the industry who's an executive who we can talk to that will help us understand that industry and where this company sits within that industry that you are looking at. So that's kind of pre-acquisition, and then post-acquisition. We have a general rule for the fund is that we'll sit on every board of every company that we buy into. So if you notice in search, typically speaking, boards are actually uh, sat on by various amount of people, and so someone fund A might sit on one board but invest in another business where only fund B is on that board. So that's what's part of the ecosystem is they trust each other, but they don't necessarily have to sit on the boards. They know George is sitting on that board, so I'm okay with that. We sit on every board, and what does that give us? Just from an insight perspective, obviously we want insight to all of the investments we make. We're very active investors. We're not passive, and so being on that board will allow us to give insight to our investors. We also take a very hands-on approach to exits. So I think in every exit that we've had, we've been on the phone with the banker every single day. And that's part of what we see as more of a private equity model versus a more traditional search model. And I think we're probably interacting with searchers, a lot more than maybe other investors are, sometimes to our own detriment, maybe because the searchers probably look at us and go, "You're a pain," and the other guys aren't talking to me. But we try and be judicious about that. But we also offer another benefit. Look, I can't, tell you that it's specific to us, but having a Canadian investor be a material part of your investment, but also part of your board as a searcher allows you to take advantage of the capital gains exemption, right? So if you have a Canadian investment with over 50% Canadian controlled, and at the end it's sold, you take advantage of the $1 million capital gains exemption. So your first $1 million doesn't involve tax, which look for the searcher is a big thing, especially if you do it through a trust and you've got a couple of kids. Then you could have $4 million or close to $4 million of exempted capital gains, and so that's a big advantage that we tell searchers as well.
And it's an important thing to note because at least my understanding from other conversations is a pretty significant percentage of search fund investment in Canada can come from high net worth individuals and other funds in the US. And that Americans play a really large role in the Canadian search fund investment space, especially in the context of the search fund ecosystem being a lot larger historically. And that's where it kind of started. Would you agree with that kind of comment that Americans make up a large amount of the capital in terms of search funds in Canada?
Definitely. I mean, look, the Canadian ecosystem in the 5 years that we've come in has grown exponentially. So I can tell you, like when we came in, it was, hey, I can give you kind of 3 or 4 people, maximum five that you can call. That's probably more like 12 to 15 now of people that you can call that will actually look at your search fund and think about investing. So it's expanded certainly. I don't think there's as many people fully focused. We're the only one fully focused on Canada only, right? There's Vonzio out there now. There's Blue Frame, very good funds, very good people. They invest either North American or worldwide. But at the end of the day, back to your point, I mean, look, if you're going to start a search fund in Canada, you're probably going to get 25 to 40% of your capital from Canada, and the rest is going to come mainly from the US. I think that's something that happens pretty much everywhere in our Canadian ecosystem, whether it's venture capital, private equity, or search, where US investors just have a different appetite for risk and they have a different appetite for return than Canadians do. So they tend to invest more dollars and they tend to be willing to accept more risk. And so they do come into Canada and they do make up a disproportionate amount of search. The good news I would say is when we started out investing, I would say to you, maybe 15% of a fund would be Canadian and the rest would be made up by Americans. And then when we went to do the deal, we would take a disproportionate amount of the capital to push the 50% envelope for Canadian control. Now you're seeing, regularly uh, cap structures be kind of 35-40% Canadian. And so that speaks to the fact that there's more and more Canadian capital going into these deals, which is, I think, great for the Canadian ecosystem.
Agreed. And I think it's a really important piece that the financial returns from successful Canadian search funds go back to Canada versus flowing more to the United States. Although it's great the catalytic impact and this risk capital that Americans can provide. So it's good to have American investment and it's good to grow the Canadian investment. To zoom into something you were talking earlier, which was about liquidation and the selling of a business once it's been acquired and operated. To as a refresher for the listeners, typically with search funds, somebody kind of sells within like 4 to 10 years. Uh, so, Glenn, who are like the principal buyers of search fund operated companies?
Yeah, look, I like to say this, and it's a copy from one of my fellow investors who says this all the time. I mean, what you're doing typically as a search fund uh, CEO is you are setting up that company for a larger private equity person organization to buy it. That's what you're really doing. So you are taking a very entrepreneurial organization, which really means an organization that was very focused typically on making cash flow for the owner, and you're trying to make that into a professional business. So you're going to add rather than subtract. So you're going to put people in the right places so that the company actually has functions that work properly. Typically, for example, the finance function of an organization run by an entrepreneur or family is very weak. And there's a reason for that. The entrepreneur or the family is usually very strong financially, and so they don't need to spend the money to do that. And so your job as a new CEO is no, I want to have functional areas. I want to have actually give everybody a job description so they understand exactly what they're doing. You want to make it look like and actually be a real company that a private equity firm can then look at and buy and say, yes, I can take what these guys did was, take a $2 million business and make it five, and I want to take it from 5 to 10, and I want to help this CEO who's now got his feet wet do a bunch of acquisitions, for example. So that's, I think, the first and probably mainly what you see as an exit to PE firms. And the second one is to strategics. So you're going to take a business that's typically too small for strategics to look at. So most strategic buyers won't look at 1.5 or 2 million of EBITDA, and they typically don't want to buy a company where there's no management involved, right? The manager slash entrepreneur is leaving. And so search offers a very, very good buffer to take it from 2 to 5 million of EBITDA, where they become more interested because it has scale. But also, it offers them the ability to say, "Yeah, I got a manager in there right now, and even if I don't need that person long term, hey, they can take me and for the next 18 months tell our corporate office how to run this business, and we can actually use him or her to acquire this business." Whereas with an entrepreneur, the fear is always this person's going to kind of run out the door because they're maybe in their late 60s, and they already own a house in Florida and they want to go spend more time there. So I think search actually offers a very important piece of the entrepreneurial ecosystem to take a company from family run, entrepreneurially run, to ready for the next level, right? And so whether that's PE or a strategic, that's typically what you'll see.
I recently read a piece by AJ Wasserman, who's like a professor at Yale that is studies a lot about entrepreneurship through acquisition, and he has a paper that you probably read called "On the Nature of Long-Term Holds." And in it, he critiques the sort of search fund industry for selling too early. That he argues the strongest kind of returns, like the Assyrians of the world, are through like buying and holding, kind of long term. And on a related point, I recently spoke with somebody who said one of the issues why a lot of search funds, in his view, sell too early is because the searcher is often in their 30s. They don't have a huge amount of capital and they want the liquidity as well. And that it creates an incentive where, the delaying the sale could, there's potentially short term kind of thinking. So, kind of on that point, Glenn, what are your thoughts on, like, do you think more search fund entrepreneurs should buy and hold for a longer period of time?
So I be at complete fault if I could ever disagree with Mr. Wasserman, so I won't. I would say to you, yes, definitely. The longer you hold, the typically the more value you create. Um, then there are other reasons for selling, right? And I will say to you, absolutely. When a searcher has a quote unquote pregnant gain of $8 or $10 million, and that person hasn't made very much money over their career, they're going to want to unwind the search fund and actually get, some of that capital. They always end up rolling some of it. But if you can, have a $10 million gain and put 8 million in your jeans, that's not a bad day for you. So that does drive some of the exits. But I will say there's other reasons for exit as well, right? Example being not having enough capital, right? The search fund community can only support so much growth. And I'm living with a live example right now where two searchers who I consider, creme de la creme searchers, have taken a company and grown it and done very well with it. But now they want to make it, a north of $10 million EBITDA acquisition because it makes a lot of sense. Well, that's really hard for the search fund community to support. It's a big amount of capital. It also involves a whole bunch of other issues. Example, I might be at year 3 of my fund, whereas Ron might be at year 8 of his fund, and he says, "Well, no, I can't put out any more capital." And now the valuation of the company becomes a critical piece of putting in the new capital because Ron doesn't want to be in any way diluted, and I want to put it in as cheap as possible. So how do you get over that dichotomy? And when there's 10 people or 12 people invested, I can tell you with 100% certainty that is going to happen, right? So that's part of the issues around search. And so it ends up being, well, maybe we should just sell the company, right? But again, back to your question, does long term or longevity in an investment provide for a longer or better return? Yeah, I would rather have a 6x return over 8 years than have a 3x return over 2 years any day. I always say multiple of capital pays bills, IRR pays nothing, right? So you want a large multiple of capital. So as we look at our fund, for example, we've had some really good early exits. We had a 3, a 4, and a 6 times exit in the first 3 years. All of those are great exits for us, and we would take them any day of the week. But we've also, at least within our own uh, management team, we've bifurcated a couple of assets where we say those are going to need to germinate for a longer period of time, but we're going to get a really nice multiple of capital on them. And so we need to hold on to those a little bit longer. So we kind of set our goal as, hey, we want to get some money back to our investors, and if we can get costs back to them over 5 years and then ride out the rest, that's a great outcome for them because we think we can deliver a fund that has 3x. But the reality is, most funds have a 10-year life, and you might be able to squeeze that to 12 years. And so you're going to be exiting most investments after 6 or 7 years. And back to your original point with Mr. Wasserman, yeah, there's a lot of searchers who sit and look at that gain and say, look, that's a life changing event for me, and I need to take it. And you know what? We shouldn't stand in their way if it's a really good return for us.
Yeah, it's a complicated question, and also I think the one thing to add is my understanding too is that there's different permutations on it. Like there are people who will do partial exits as a company grows. They'll get some of their equity out, and to your point, there's always some rollover. Although my understanding is it can vary, significantly. And there are some, and there's often in the cases where a search fund company grow like is on that growth trajectory. Sometimes search fund investors will be largely bought out in the early stage, and then the growth investors kind of come in. But there's still all of kind of the investors in the mix. And I was recently speaking with one person who seemed, I think it was one of the first search fund entrepreneurs in the country. And he was talking about how the company he had originally bought, I think it was like 5 million in revenue, and now it's 150 million in revenue size. Anyway, I share that in the point as more to say that there are many different trajectories of ETA for our listeners. There's the ability, and maybe in some cases it makes sense to cash out early. And there are some cases with search funds or other kinds of ETA where companies can grow to a very significant size.
Yeah, I mean, look, as I said before, capital drives a lot of opportunity, right? So, in the case where you're talking about, right, I think that individual benefited greatly from having a new set of investors come in, right? More capital, able to do a big deal. But also, I tell investors, like, look, most search fund investors are smart people who help the company to some degree. I've worked at a couple of private equity firms. The level of scrutiny, the level of involvement, but also the level of intellectual help is exponentially greater with a private equity firm. You're not going to get as much upside, but you are going to get a lot more help. So, all that stuff that you're doing on a day to day basis to dig through numbers, they're going to slap a really smart associate onto your file, and that person's going to be able to do that much more quickly for you. And that gives you the ability to think much more strategically about growth and have that person help you kind of fill in the gaps. And, if you're a search CEO, you're going to go one of two ways once that happens. You're either going to get extremely frustrated because, hey, this guy's in my socks every day and I can't stand this, or you're going to embrace it because you're going to say, wow, I'm learning a lot more. And I didn't realize how much more I could get out of this company, because sometimes it feels as though those people are running the company for you. But the honest answer is, they can bring a lot of horsepower to help you get to the next level. And so, if you stick to your knitting and say, look, my job is to continue to drive this strategy and grow this thing, and they'll help me fill in all the gaps I had before that, probably you shouldn't like doing. You can take it from where you took it from to a search side and say, hey, I've got 5 million EBITDA. And if you're a really forward thinking person, go, hey, I'm going to get this to 20 million of EBITDA with these guys. Like I went on a small ride with the search fund investors. I'm going to go on a big ride with the private equity firm.
Glenn, if you could go back in time and give advice to yourself from like 10 years ago or whatever before you kind of actively became involved in investing in search funds and other entrepreneurship through acquisition vehicles in Canada, what advice would you give yourself?
The first advice I'd give myself is don't eat carbs at your desk every day. Um, but aside from that, I would tell you that the advice I would give myself as an investor is if you see an opportunity for something that, seemingly is going well and is early days, I would have gotten earlier if I could have. I think that the people who saw the opportunities in Canada, the Rob Churns of the world, like those people have done very, very well in search because they embraced it early on, and early adopters do very, very well. And so if I could go back 10 years ago, I probably would have invested more of my own personal capital in this, and I would have learned over a longer period of time what search was. And then I would have still been where I was today. And I still would be running a fund because I absolutely love it. And if that hasn't come through enough, I enjoy every day of my life right now when I come to work, except when it's tax season. Yeah, I wish I had learned. I wish I had listened to Mario Negro earlier, who told me, 5 years before that, you got to invest in this. You got to invest in this. And I just was like, this is crazy. Why would I do this? And I'll never say this to his face, but he ended up actually being absolutely correct. And you know what? Maybe we started 5 years too late, but it's not too late now to continue investing in a
Yeah.
really good industry.
Well, I'll have to send this episode to him afterwards. But by the way, and to say, I wouldn't be too hard on yourself, because it does seem like you're still quite early mover in the ETA ecosystem in Canada, as it's you're far ahead of a lot of people, and it still seems like relatively early days. But Rob's story, by the way, I think is fantastic. I actually just spoke with him a couple of weeks ago in terms of the very kind of early days. And when he first, he had a great description of when he first met Mario, and kind of the initial sort of sparks of ETA in Canada. But yeah, Glen, it has been a great pleasure speaking with you today. Thanks so much for zooming in particular in the search fund kind of investing world. For our listeners, we're going to be doing other episodes about entrepreneurship through acquisition in the future. So if you're interested in this topic, I encourage you to continue to listen along to future episodes. And Glen, thanks for everything that you do to support the ETA ecosystem in Canada. I think that it's great to have a fund like yours that's focused exclusively on Canada. And yeah, I really appreciate you sharing your insights today.
Thank you, and good luck with all the venture in Canada that you do.
All right, thank you very much.
Thanks for listening to this episode of A New Wave of Entrepreneurship. Stay connected with us via our socials and through our email list. And be sure to subscribe to us in your favorite podcast app so you don't miss our next episode. Have feedback on today's episode? Let us know directly in the app. Thanks again for listening and for joining the new wave of entrepreneurs. Till next time.